Hello, everybody. Welcome back to another Wealth Management Advisory Club meeting. Obviously, if you guys did not see our LinkedIn profile, George Shuley did present Villanova University last night. So pretty big deal for me. I will say this again at the end of the meeting, but just beforehand, we are going to have our Chili's fundraiser tomorrow night, 6 p.m. at midnight. It's at Chili's East Hanover. Come out for a great time. The money will go to the WMA club. So it'll be a great fundraiser everyone to come to. But getting to today's meeting, we have Todd Healy and Michael McKeown. Hope I did not pronounce your last name wrong. Just going a little bit about who Todd is. So Todd Healy focuses on operational strategy, process improvement, and new business opportunities. He joined Marcum Wealth with over 25 years of experience in the financial services operation. And basically, I'll pay for that. But with that, guys, please turn your cameras on if you can. Ask questions as much information as possible. And with that, Todd, Michael, I will leave this up to you guys. Let's take it away.
All right. Well, thank you for reaching out and inviting us to this. It's always good for us to make connections, and you never know where things will lead us. I always like to say it's a small world. Especially when you look at our world of finance, no matter what, it truly is. So Marcum Wealth, let me give you a real quick high overview of what Marcum Wealth is and what makes us a little bit different. Mike's going to be able to talk through brilliantly on strategies and how his team approaches running the investment portfolios, which I think you guys might be more interested in. I'm passionate about operations, so Mike's got his passion, I've got mine. But really what makes Marcum Wealth a bit different from many other firms out there, we are affiliated with Marcum LLP. Marcum LLP is now, because of an acquisition that they just concluded a month or so ago, they're now the 10th or 11th largest accounting practice in America. So one thing that I'm really looking at and charged with doing is finding a way for us to partner with Marcum LLP and really try to set up locations wherever Marcum has CPAs. Most wealth advisors, their biggest struggle is where they're going to find their next lead. Where are they going to get a referral from? How are they going to grow their book of business? We have an incredible network of thousands, literally, of CPAs that are affiliated with us that we just need to work with so that they can see the value that we bring as a team and how we can partner with them to better serve clients. So we are growing. Currently, I believe we have 8 or 9 offices, I think in 5 states. My goal is in the next 3 years to get that up to about probably 25 to 30 offices. So we are definitely in a fast growth mode. So a little bit about that. And then I'll talk a little bit, because we've got some size and structure where we have what I like to call 3 pillars under this Marcum Wealth umbrella. Our first one is the traditional RIA business. That's the fee-based assets under management. It's about $2.3 billion that we manage there. We've got another pillar, which is the retirement services. So that's focused in on the 401k plans, 403b, simples, that type of business is handled through that channel. And then we have a third pillar, which is a separate legal entity called Marcum Insurance Services. And really the reason that we've kept those separate is that is a FINRA regulated structure, and the RIA and the retirement services piece are SEC regulated. So it's our purposeful approach to really keep regulators in their proper swim lanes. So that's kind of a higher overview of who we are and how we kind of approach things. I'll toss it to Mike, and he can certainly walk through some of his investment frameworks and how he, handles the day-to-day questions.
Sure. Happy to dive right in. I guess just give you a little bit of background on myself before I dive in there. So I've actually been working with the same team now for about 18 years. So I started as an intern at Morgan Stanley. Our team, shortly thereafter, about a year after I was there full-time, decided to leave and start a registered investment advisor with a regional accounting firm. And then that regional firm eventually merged with Marcum, and Marcum really hadn't built out their wealth management business that much. So we actually acquired their practice, which was a handful of advisors in different offices, and really brought them under our umbrella. So I was back in the day an accounting and finance major. So I'm not sure if everyone's on the investment side or finance or wealth management track. But as it stands today, I'm really responsible for 4 areas of the firm, which all falls under the research purview. So we really invest our clients' money based on starting with a financial plan, and it doesn't matter if you're just starting out or you're a client that sold a business for several $100 million. We complete a financial plan to really dive into what objectives you have, what constraints there are, what tax opportunities do we have to help make an efficient transition of assets. And so we really start with that, and that leads into our first area that I'm responsible for, which is asset allocation. So thinking about the mix between stocks, bonds, real estate, private equity, and really building out those allocations. And on an ongoing basis, we're analyzing, capital markets for opportunities inside of each of those major asset classes. That leads to the second area, which is our due diligence and through investment manager research. You'll find, most institutional investors do not sit there and decide what equities they're going to buy on an individual basis. If you're talking about an endowment or family office or a pension plan, they go out and find specialists in each areas to execute, whether it's finding the best international value manager or the best real estate value add operator, finding the best municipal bond fixed income manager. They're going to find managers to actually execute on the individual securities and underlying assets. So that's where our due diligence process comes in, to really go out and find those managers to implement our asset allocation on behalf of our clients based on, people, process, and the portfolio opportunity set. The third area is our trading and implementation, which really centers around making sure that from an operational perspective, we get those assets into the most tax optimized strategy. And we do a few things on the tax side to try to make sure that people are keeping what they earn in terms of returns. And then finally, communication. So I write and record a lot of content. Actually, probably after this, I'm going to record a video for our clients and talk about the inflation data that just came out today and some of the recent Fed updates. So really try to get out there, communicate what's happening, and that includes hopping on calls with our clients, whether it's individuals or our 401k plan. So making sure that people and our advisors as well, to make sure that they understand what's going on in the world and how we're responding to the news of the day and in terms of managing risk and taking advantage of opportunities. So happy to dive into any other areas or whatever would be most helpful for you guys.
Start off. I'll start off. I know some of our members are actually looking for internships in the next couple of weeks. Do you guys have any in-person or remote internships for Marcum Wealth?
We do in person. Kind of hard for us to be able to do remote, but we definitely do intern. I think last summer, I think we had 4. Right now I have 2 part-time during the school year.
Okay.
But I would encourage everybody to really seek out internships. You know, it's a great way to get an introduction to the business, really learn more about different areas as well. You know, some people are going to come in and say, you know what, I'm inspired by Mike and I want to go get my CFA and go down the investment track and really drive that process. Others are going to say, you know what, let's leave that for the Mikes of the world. And I want to be more of a financial advisor at some point. And how do I start thinking about a CFP? So I think getting exposed and seeing things within operations, compliance, what's happening maybe on the investment and trading side, maybe learning a little bit more about what's happening on an executive side. I would highly, highly encourage everybody to seek out internships.
Definitely do that there. So we do encourage our members to go see her out for each placement program for internship opportunities. And, you know, I actually have another question. So we do have, every time we bring in a speaker, I usually hear, you know, oh, some people have, you know, want to go down the CFA route, some people want to go down the CFP route. In your opinion, for anyone who's like planning on the wealth management or like financial planning, do employers look for CFP certified, or they look for, you know, applicants taking, like, plan to take the CFA exam? Because I heard like from other sides, like, oh, they plan to take CFP, I want to take CFA.
You know, I think, you know, that's where you got to be a little more introspective, and decide, you know, what do you want to do? That's just me. And I'll tell you a little story just about that. Because, you know, back when I was in college, I knew I wanted to be a finance major. And I was thinking I'll do an econ minor. Sounds good. And my intro to accounting professor was like, you know, this is something you seem to be pretty good at, and you should think about doing an accounting major. And I thought, I don't really want to do accounting, but they sure got a lot of jobs at the school that I went to. All the big four accounting firms recruited, and I was like, this is a good background and good foundation. And it came time to sign up for internships, and all the big four at the time and some other regional firms had interviews lined up, and I just couldn't sign up for it. Like, in my gut, I couldn't do it. And somebody from the career services like, what happened? You forgot to sign up. I was like, no, I didn't. I just couldn't do it. Deep in my belly, I just didn't want to do that. And came time in the spring, the next summer, I didn't have an internship, and I was like, well, I need a job. I don't want to work at the golf course again. So I had an internship lined up at, of all places, like a coal company on the accounting side. And I had that offer, but then I got a call from Morgan Stanley, and I was like, oh, and funny story was I dropped my resume off at the job fair with Morgan Stanley. One of my fraternity brothers was like, McKeown, what are you doing? Morgan Stanley doesn't want you. So that was a great intro. But nonetheless, I ended up, just for the opportunity to interview, I turned down the internship on the accounting side just for the opportunity, because I knew I wanted to get my foot in the door on the investment side. And, you know, was fortunate to find a team that, after we launched the firm, I was going to go more of the financial advisor route. And that was kind of the plan, because at the end of the day, if you're an advisor, you know, you have to be servicing clients and want to be, you know, helping people on a day-to-day basis and really out there understanding their financial situations. You know, the investment side is maybe a little less hand-holding going on, although I certainly did that today. It really is what the main purpose of one of our client calls was, just to help somebody, because they were very emotional about their portfolio, which actually has done pretty well year to date, all things considered. But I think, you know, I just say that story because I can't tell you what that fire is in your belly. Like, do you want, and I think you're not going to know until you're in an industry or you're out there a little bit more. And so I'll answer it and say, if you are going to be a financial advisor, if you should get your CFP, like, for sure. If you are going into the investment side and the asset management world and want to work on an investment team, whether it's inside of an RIA, whether it's at a pension plan, the chartered financial analyst designation is a must as well, or it's not necessarily a must, but it certainly sets you apart, right? So, and I mean, I think that's what we're all trying to do to a certain degree, and it definitely is. I think both of those are the gold standards depending on where you are going, and so it really is a very personal decision. But and it also is what is the opportunity set that you also have as well. So so it kind of comes down to that. I think we encourage our team. My research team is encouraged to do the CFA exams, and they are, and on the advisory side, we have people taking the CFP. So long-winded answer. I don't know if Todd has anything to add, but that's just something I speak with personal experience from in terms of going down. And by the way, I did get my CPA, funny enough, because sometimes you got to hedge, sometimes you got to put a portfolio hedge on, sometimes you got to put a career hedge on. And I knew if I got my CPA, I'd always have a job. So you got to hedge the downside sometimes. So if the advisory world didn't work out, I could have always done that. So
Yeah, I will echo a lot of what Mike just said, and I would say a CFA is overkill if your desire is to be a financial advisor and work with kind of the everyday millionaire next doors. It's unnecessary because you're going to be relying on people with CFAs, the Mikes of the world, who are just living and breathing this stuff that you don't have time for if you're working with clients. You don't have time. You've got to be able to focus. So there, the CFP is going to make you much more relatable to your end client. So
yeah. And I'd say too, a lot of firm, and I came from Morgan Stanley. Sometimes people are trying to do both roles where they are an advisor and a portfolio manager. It doesn't really work very well. We very intentionally have set the firm up this way because imagine you have 200 clients and you have a fund or an idea that in a short-term basis didn't work out. You may not make the become rational economic man and make the best investment decisions because you are getting emotionally punched in the face by your clients every day for saying, why do I own this? And you're just like, sell it. Whereas a rational investor might say, gosh, this is now cheaper. There's good fundamentals and it's a good idea. So there's a separation and a different skill set that I think both need each other because it doesn't work if we don't have any assets to manage and clients that will stick with us over the long term and that our advisors can convey the long-term message and financial planning approach that we have, and it doesn't work if we don't execute on it. So
no, and I would say, the whole emotional disconnect is why clients want to work with a financial advisor, because they need to distance themselves from that emotion and seeing that, oh my goodness, I should have sold Facebook a week ago. To be able to have some of those comments and really kind of drill through it. Mike and his team removed that for us. It's funny because I'll talk to people and they'll say, I can manage my own money, and I'm like, okay, December of 18, what'd you do? Markets had a heck of a pullback. What'd you do? What'd you do in March of 2020 during the COVID piece? Did you sell off? Did you stay? Did you put more dry powder into the market? What have you done this year to date? Through the first, 3 quarters of the year, the market was down 25%. What'd you do? So proving to them that there is value and why you need to bring in experts to really run that money without the emotional component that you naturally have over it.
Question. We have a question on Zoom, I think.
I have a question actually. How would you say, or with the midterms being earlier this week, have the midterms like what's the best way to say? Do the midterms make you adjust your portfolios, or let's say the results of that, or are you guys just invest for the long term?
Yeah, I think a lot of those big events are so obvious that not what's going to happen necessarily, but just that there becomes a lot of angst around those. And so, we're responding to what asset prices are already giving us, and trying to say, what do these asset prices imply today? we know historically the midterms are actually a very positive catalyst for risk assets. I mean, it's very well documented. And so, at worst, we've already game planned out. So part of my role, and I didn't really explain everything, but we have a team of analysts and trader. I work with I answer essentially to and lead our investment committee, which is made up of 4 of our partners and myself, that decide, hey, we don't just say like, oh gosh, there's the midterms, what are we going to do? It's like, look, we've already laid out our game plan quarters in advance of where do we want to buy things, why do we want to buy things, and where would we sell things. So we're looking at what those markets imply. So at worst, we're saying, well, we know that if we knew, 9 months ago, midterms were a very positive catalyst, generally speaking, just getting past the event. And, even though they're probably surprised, right, to the downside on the Republicans, for the Republican side, doesn't make a huge difference. Obviously, today you see what was a much bigger impact was a CPI report, with, equities up 5%, or large caps up 5, small caps up 6 and change. So we're trying to say what that's how we're responding, because I think the news is very hard to react to and say, I could give you the Wall Street Journal tomorrow and you might say, oh, I know what trade to do. And it might go the opposite way. So we try not to do that. We really do take a long-term approach, because we think it's hard to have an edge on a short-term basis, whereas on a longer-term basis, asset prices tend to converge to their mean or median returns. And so whenever markets go down, I think they're serving you an opportunity to give you a chance to find and decide where do you want to be positioned in light of your longer term outlook and how that aligns with each client's goals that you have. And so we run asset allocation frameworks across our portfolios so that each client has the right risk tolerance within their portfolio. And we're managing around that and have constraints of how aggressive or how far from around the bands of each asset class that we can be. So, but no, certainly we're paying attention and are aware of the big events that are coming up and thinking about those, but not necessarily saying, hey, we're going to make a big change, but just trying to say, hey, is there, if something totally sold off, is it like, oh, does that hit our buy levels that we had on XYZ asset class? That's how we're trying to approach it, more or less.
Thank you.
So I know you were talking a lot comparing advisory to the investment side, and through my experience of kind of applying for internships, talking about things, I personally am really interested in the investments. It's just much more competitive, much harder to break into. So my question would be, like, what advice do you have for someone who's kind of headstrong on the investment side, but is finding difficulty breaking into it?
So what do you mean you're headstrong on the investment side?
Like, I know personally.
Oh, you want to do investments. Okay. Sorry. I didn't know if you already have your own investment philosophy that you are pushing upon the firms that you're investing with. So, I think, one is demonstrate, I think I tell this to people a lot and it sounds stupid, and maybe I'm now aging myself because I think Twitter is awesome. Not because of Elon or anything, but because finance Twitter there's just all these market professionals that are out there having real conversations. I've seen people get jobs. I've seen them get full-time jobs from participating in Twitter. Crazy, right? But they decided, hey, you know what? I'm gonna start a blog and just talk about my investment journey and what I'm learning and things. And so I think the one thing that you can't fake is enthusiasm. So whether you do it on Twitter or you have the chops to have those conversations. Are you reading Bloomberg.com or the Financial Times, or are you aware of what's going on in the industry and on the investment side? And that can have a conversation like, hey, are you going to institutionalinvestor.com, RA Intel, just understanding what the issues are from an investment perspective, and can say, oh yeah, this is kind of interesting. This is what I learned, and I'm I wonder what you think about XYZ. Like, what do you think about private equity valuations? They're so disconnected from public markets right now. Like that's like the ubiquitous conversation at every conference right now. So, just showing that interest, I think goes a long way, and thinking about, hey, how do you think about investing tax efficiently, or just all of those things. So I think there's such a plethora of information. It's almost too much now, but it can arm you with the ability to have those conversations and separate yourself. The other side is also the charter. I've been on the CFA Society board of Cleveland for 4 or 5 years, and they've definitely offered more. So if you don't have, I think it's overkill to do it during a semester when you already have a full load of classes. But if you don't have an internship, looking at doing the level 1, could be a differentiator and show your interest on the investment side, as just an idea, especially over a summer if you have time available. So I don't know, happy to dive further, but I think there's just putting yourself out there, and also getting the reps, whether they're like their workout reps, reading yourself and having conversations about manager due diligence and just fund structures and all these types of things that we all do on a day-to-day basis. Like, people want to know that you're excited to do it, because people are going to teach you anyways. But if you show that you have that enthusiasm, that goes a long way, I think, in terms of people wanting to teach you.
I think I'm good. I actually do have a question. So obviously I assume you said you worked at Morgan Stanley before this. I assume you're an analyst there. What did you do at Morgan Stanley?
Yeah, so I really got hired on an advisory team, and that from 2 guys, Eric and Chris, and Eric is now our CEO, and Chris is one of our managing partners. And they didn't have the analyst program, or they started it like right after. And so I went right into the advisor program, and they said, "Hey, you're 22. Why don't you go manage try to find $4 million to manage in your first year?" That seems like a great idea. No, it's kind of silly, but it's a sales job to get assets under management, but it's just like so antithesis to professional services, like an accounting firm. We're affiliated with an accounting firm. I've got friends at law firms. Their job, their first year, is not to get $50,000 of revenue. It's to learn how to work and do work. And so Eric and Chris fortunately saw how silly the advisor program was, and more or less created an analyst program. But I got to kind of chart my own path to a certain degree. Part of it was sales, but it was kind of like lighter, like doing light business development. And then the other side was asset allocation and fund research and portfolio design. So, I kind of was fortunate that I definitely was fortunate that I found these guys, and I think it was mutually beneficial too, because I had, a big desire to learn and just go on my own. And so when we started the firm, I was our chief compliance officer. I had financial advisor on my title, but I soon thereafter said, "Hey, I want to do the CFA program. And by the way, guys, do you care if I start to write on the website?" And they're like, "Yeah, go ahead." So I was doing all of those things at like 24, just because I kind of asked and they said, "Yeah, we need all of those things done." They more or less told me to do the chief compliance officer role. I wasn't excited about that, but but nonetheless, that's kind of how I started. And I was the first one to leave to start the RIA, leaving a few months before them to help get everything ready to launch the firm as we launched it with an accounting firm. So.
Awesome, thank you. So following up on that, I had an interview with a private equity firm the other day, correct? And they were pretty heavy on technical questions during the interviews.
Mm-hmm.
In your opinion, how important would be the technical side of the interview versus, say, behavioral questions and vice versa?
I obviously I think a private equity job is much different, I think, in terms of the expectations on a technical versus behavioral. I would lean a little bit more on the behavioral side, because I think there's a lot of interpersonal skills that you need to have managing internally, as well as talking to external partners. So I think that's important. Certainly you have to have a baseline of technical ability or ability to learn those skills. So for me and what I look for, and I've only been hiring people for a few years now, so I don't even know if I'm that good at it, but that's what I look for, and I think it's worked out so far. So
Okay, thank you. That makes sense.
I do have a question. I would usually ask this question, I think we had a couple speakers kind of in the past, and I've asked this question, and it actually is a challenge we have here at FDU Silberman. I think the winner of this get $100 for this question. So according to a study from Northwestern Mutual, found that actually U.S. adults anticipate they're going to need $1.25 million to retire comfortably. And I usually ask all these speakers this question just to get their own opinion. Do you personally feel like $1.25 million is enough for you to retire at the age of 65? Is that reasonable, or do you think it's more or less maybe retire?
it depends.
That's exactly what I was going to say, because
Depends
we
on
do
what
a
you
lot
spend.
of, we do a lot of planning, and there's certain things that you control. Well, one of them is what your expected spend looks like. I can't tell you how long you're going to live. If you retire at 65, are you going to drop dead in 5 years? Are you going to be around to 95 or 105? So to just kind of peg and put a number out there is kind of crazy. But yeah, I guess if I wanted to go live in a mobile home in the middle of Oklahoma, I probably could. But, it's, what do you want? Do you want to be able to travel? Do you want to be able to do some of the charitable things that you're doing? So I think it's really unfair to kind of put a dollar amount.
Yeah, I mean, I would disagree with that. That you'd have to live in a mobile home necessarily in a bad way. Honestly, I have a friend that owns a lot of mobile home parks, and some of them are pretty nice communities, to be honest. But it all depends on your save or your spend, right? Like at 65, you'll be getting Social Security. You have a reasonable withdrawal rate. Depends on how aggressive you are. It just depends. Like, can you live on a spend rate that is okay? I don't know you, so I don't know what you like to spend on. And I imagine your spending is going to change over time. And so it just depends on the person.
For that question, I think the premise is more of how do you maintain that lifestyle with, say, certain investments that let you to pay all the bills or whatever you need while saving retiring. So I feel like more of the questions about like how you should invest for your retirement fund and things like that. Like whether it be say dividend allocation or whether it be some other things. So I feel like, what are your thoughts on say, oh man, never mind, I just forgot where I was going. Do you remember where I'm going with this?
Yeah, I know where you're going. So do you feel like $2 million?
No, pretend to say.
Yes.
Could I ask you on your outlook with the markets? Because from what I've read through the past years, a bear market usually lasts for what I think they said less than 2 years. And a lot of economists already can debate whether we've been in a recession for a while now, or if we're heading into one. So with all that coming together, I mean, are we going to head deeper in a recession, or are we already in one and we're kind of making our way out? Like, I feel like there's so many mixed signals and everyone's talking a little differently that I can't tell you where we are at this point.
Mm-hmm. Yeah, so that's actually the leading slide that I have in my deck currently. Actually, it's been this leading slide for 2 quarters now, and it's I asked people to raise their hand if they think we are in a recession, because we did have 2 negative quarters of GDP to start the year. But if you look at the group that actually dates recessions, and you hear from economists that I respect, and they would say we have not seen a broad-based decline in economic activity despite the GDP being negative. And so I don't think we've been in a recession. I don't think we are in a recession either at this point. I think the risks are elevated going into 2023 because of the lagged effect of monetary policy and the Fed raising interest rates. We don't know the damage that's going to do, because by definition, it lags by 12, sometimes 24 months, I think we're already seeing the effects, especially in the housing market. So I think it's hard to handicap, an outlook, right? Like, economists, it's a really tough, difficult job. And so, I would caution and say, I'm not an economist, and my investing does not depend upon my accuracy in terms of forecasting events to precision, because, those are just outlooks. And I would encourage you to, like anyone, to be very skeptical of people that don't have to make decisions with real money, because anybody can write anything, and there's going to be people that in the future you'll look back and say, gosh, and they were right in December of 2022 when they were writing. Well, they may have been writing that for 5 straight years, and finally it happened. So that all said, I do think the risks are extremely elevated for a recession next year, given a lot of the indicators that we see. My hope is that it's shallow, and that this is more of a garden variety business slowdown that is a buildup of inventory. You're seeing inventory levels really rise, and that it's rather sanguine overall. In terms of markets, it depends on the outlook for inflation. I do think in the shorter term, I'm pretty bullish on markets as it stands, and over the long term too. At the end of the day, we forecast our client returns over a multi-decade period, and really thinking about where will stocks be. If you have a liability in the next year, you should not be invested in stocks, right? Like, that's a bad. Stocks are a very long duration asset, and you have a liability that's very short. So generally pretty positive again over the short term, and if we avoid recession, the investors are very underinvested. And I will tell you, like last year, we were telling clients, hey, it's time to rebalance and come back home to your target portfolio because you were way overweight. Well, now most portfolios are way underweight their risk tolerance on average when you look across the spectrum. So what have we been telling people? It's time to come back and get closer to home. And not just telling people, we've been executing on that, because that's really our mandate within clients' investment policy statement. It's harder to do in practice when the news is horrible and you have recession and inflation and all of these things going on. That's what challenges you to stick to an investment process that is tried and true, over a multi-decade period. So I don't think you need to forecast. Is in general, it's fun to kind of think about, okay, what scenarios, what might the conversations be though? And I think the conversations 6 months from now might be, gosh, hey, the Fed has finally paused rates. What will they cut them? Because because maybe there's too much, that we start to see unemployment do rise a little bit. Inflation in 12 months, it may be under control, or at least down substantially. Do we need to have the Fed funds rate at 4.5? I think those are the conversations. That's how I'm trying to think, what's the conversation going to be in 6 to 12 months? And that's where I kind of lean overall. But I think, it's hard to get too bearish, but we have had very long bear markets. The 2000 to 2003 bear market lasted 3 years. So, and the funny thing is, I'm sure you all took Stats 101. Like, we don't have a big enough sample size of recessions and bear markets to make them statistically significant. So it's hard, while it's fun to look at these, we can't just say, well, it was like this on average, so we should expect it. It's good though to know those stats and say, hey, at my marginal dollar, should I start to add? Where should I look for opportunity? What outperforms after bear markets? Small caps, mid caps, high yield, those types of things outperform. Where should I position given what I know today that I don't have to forecast? So, long-winded answer. We can go on forever. I'll let you guys ask another question though.
Any other questions? Zoom? Anybody? I'll ask one. What's the best piece of advice you get to a college student playing on, maybe going for their master's, maybe, just finishing out their senior year of college? Like, what's the best piece of your advice you can offer to them?
It's a good question, Todd. I'll think about it. So, well,
honestly, that is a great question. Just know that you need to get in and get experience and figure out what it is exactly you want to do. The other thing, obviously depending on where you stand from a debt standpoint following graduation, getting rid of debt as soon as possible, avoiding debt, where you can in the future, and start investing. There's nothing more powerful than when your money starts making money. So you guys are young, you've got time on your side, and we can all talk through the power of compounding, but that's really a huge benefit for you guys. You're looking at 40 plus years. You can take any period in US history over a 40-year period and the markets are up significantly. So start investing, as soon as you can, when it makes sense. I'd also tell you, make sure that when you have your first job, contribute at least enough to get your employer's full match. That's just free money on the table. So never walk away from taking their money. I don't know, Mike, if that sparked anything in your mind.
Yeah, I think what I would tell you to do is really go out. I think these conversations that you're having, that we're having today, and learning about it, learn about every aspect that you think you might have, any industry that you might think you have an interest in. There's a lot of areas that are you guys all, is it wealth? Are you guys wealth management majors or finance majors?
Finance.
It's a mixture, accounting, finance, wealth management.
Yeah, and so, and I'll tell you, I have friends that from the finance industry. One went into investment banking. Now he works for a fish startup company. Got another friend that's been in real estate forever, and is a real estate broker and owns a lot of real estate himself personally. And I've got other friends that got into business after being history majors. So there's a lot of different ways, and I think just exposing yourself and talking to friends and being very inquisitive about it, about just learning what they do and what sparks an interest in you, and then like going into it. There's so much information out there. And I think at the end of the day, listen to your gut and like what drives you, and find a good mentor. I think that's kind of the key is at this age that you're at, where the people that you start out working for are going to be very impactful to your career. And, make sure they are very high integrity individuals, that you respect them, that you look up to them, and that you can learn from them, and that they're willing to teach you, because they're going to have a big effect. And so make sure that you select the right group that's for you, and really, and I'll be honest too, like I didn't pick the job that paid me the most money right out of school, because it would have definitely been on the accounting side more than it was being in a financial advisor program. So, while I can't emphasize that enough, is like finding the right people is going to be worth a lot more than the starting salary that you start out at 22, because you're going to have a long career. And make sure it's like something that you're excited about doing, that you really want to do deep down, because that's how you're going to separate yourself. Like, if you're doing, you might think, oh, well, I'll be in the I'm going to be in the highest paid industry, I want to be a hedge fund analyst, but you just like don't really like it that much, like you're dead. Like you might as well not even do it, because there are going to be killers out there that are coming for it, that have more passion. So make sure you have that passion deep down, and you're ready to rock out and do it.
So you were saying, talking about finding the right group, correct? What would be the best way of finding the right group in your mind? Just joining to like as many events as possible, or maybe?
Yeah, man, hustling. Yeah, I mean, you got to show up, right? Like that's part of I'd say as many events as you can. Don't be like, oh, I'm tired on Thursdays. Thursday's my night to go out with the boys. I get it. I was in college. I get it. But like, go to those events that not everybody's going to. Network with your friends, your friends' parents that but don't be like, oh, hey, how do I get the internship? Be like, hey, what do you do? Like, what do you like about it? Like, what makes it cool? And would you recommend something? Is that a career that you think I should look at? Or is this a business? Or, I'd start out from that angle to make sure that it's like kind of a one-way street or two-way street. And so, yeah, you got to show up, get online, find people that you respect and think are interesting, follow them, maybe ask them questions on Twitter. I'm just saying, I think it's you can't just expect, you got to make it happen, right? Like you got to make it happen some way or somehow. If you're not in that industry, and believe me, I didn't have anybody in my family that was in the finance world. So like, fortunately it was at a good school that had connections and had good job fairs, but I showed up to them. And at least, even though, like I said, my fraternity brother said I was a moron for giving him my resume, but
What fraternity were you in?
Kappa Sig.
Same. Oh.
Oh, right on.
So, yeah, here it's funny. We're starting Kappa Sigma here.
Oh,
So,
no. Yeah.
See, I'm like a founding. I'm also on the Grandmaster ceremonies right now.
Yeah. So I was a founding member of our firm, or of our fraternity at John Carroll. They're unfortunately no longer there, for reasons you can probably guess. But but yeah, no, that's funny. That's great, man. Good for
That's
you.
awesome.
All of a sudden I've got Animal House in my head.
Well, it was John Carroll. We were a good Jesuit school, so it wasn't that out of control.
Anyone other questions like that? Anyone on Zoom? Gentlemen, you can ask a question, put in the chat if you want.
Could we connect with you, and if so, how? Either Michael or Todd.
Oh yeah, definitely. LinkedIn is probably my easier spot. I'm not much of a Twitter user. I would say reach out to me on LinkedIn.
Yeah, so Todd handles all of our, hiring and everything like that. So that's where I would encourage you to reach out.
We definitely will encourage all members to reach out.
And I would encourage everybody to, to go out and start following Marcum Wealth on, social media. We've got Twitter, we've got Facebook, we've got LinkedIn. We've actually been talking about TikTok, but so actually let me throw this one to you guys. So you're a different generation. What do you think about us considering TikTok?
I think, personally, we do have our own TikTok for WMA. I think we can bring it to it. I've seen other companies have done, like here in New Jersey, like IMA, NGCP, doing, I think a couple of accounting firms actually have TikTok, even like wealth management firms do. So I think it would be definitely a great way for you guys, just to network to the young generation and put yourself out there on TikTok. I think it's an awesome idea. I don't want any money from members measure.
Yeah, I think TikTok is one of the best ways to do it now, because a lot of people, like a lot of the kids my age, have very short attention spans. So TikTok is kind of quicker sort of networking out. So yeah, I think TikTok would be a great idea.
Cool.
Any last questions? Joe, Matt, anybody? All right, I guess I'll ask the last question tonight, I guess. So if you were to go back in time, like maybe like your college self, your high school, like a senior high school or your senior year in college, or even like a freshman college, what's the one piece of advice you would tell your past self to do better?
Oh man, I feel like I'm on a podcast right now.
No, that term did not exist when you were in college, Mike.
It did not. It did not. It was pretty shortly after though. Come on, Todd. Come on. I know I got. I think I just wish I would have learned a little bit more about, and I knew that I didn't know this in school, but I probably just didn't. I didn't do it enough. Was just really going out and learning more about different industries, and just everything that's like tangential to finance overall. So I just don't think I did that enough. So I would say get out there a little bit more and be a little more diligent about learning what different folks do and and how it's all connected. And I think and more just reiterating what I said before, like really find, and I think I did it, but I still would tell myself like, hey, make sure you're with high integrity people that you trust and respect. because that really matters, especially, you know, you see it every day, right? Like you see it in the news. I don't have to tell you what's blowing up the headlines right now, but like integrity is a pretty important thing. And it's funny, like we all probably take business ethics, but it don't steal your client's money, or you know, it's kind of some simple things, but it comes back around. So I don't know, I would just, you know, if you really have that itch that you really want to be in the industry, like you'll find a way to make it happen, and just trust that process. So
Yeah, and I would throw on top of that, use the tools that are out there. I mean, you do have Twitter, you do have obviously internet searching, find people, connect with them. People like to talk. You know, people truly, truly do like to talk, you know, and if they don't want to talk to you, trust me, you don't want to talk to them. You know, but just reaching out to people on Twitter, on LinkedIn, figuring out who does what at different places. You can research the heck out of a company before you ever even reach out to somebody. You know, decide where you want to go, what you're thinking about doing, and find people who are doing it and reach out to them. It truly, truly, the people that are good, that, you know, will take the time, they're the individuals you want to talk to.
Awesome. Thank you so much, guys. Thank you.
All right, so I think that's all that we have right now. So thank you so much, Todd. Thanks so much, Mike, for coming on here and speaking to us today. And definitely we will make sure to connect you on LinkedIn and other social platforms. And yeah, with that, that's it for you guys. Thanks so much for coming in.
all right,
Thanks
everyone.
guys. Have a great evening.
Thank you.
Equal members, everyone, my club members, stay behind. Just this.